Good afternoon. I'm Lucrezia Reichlin, Professor of Economics at London Business School and trustee of the International Financial Reporting Standards. I will start this 4-lecture series on standard setting for sustainability in the African market. My fellow lecturers are Ndidi Noli Edosian, who is here with us today. She's a board member of the International Sustainability Standard Board, which operates within the IFRS Foundation, and Richard Barker, equally a board member of the ISSB. So let me start with a few introductory words. We are doing business in an unpredictable world. You'll have to agree with me. And climate change, dwindling natural resources, increasing demands on our energy and food supply are disrupting business operation and supply chains in unexpected ways. So it's more important than ever for private and public organizations to fundamentally rethink the way they function. Transforming into a successful, sustainable business requires new levels of resilience and agility rooted in responsible practices that preserve our planet. Sustainability is a business imperative and should be core to the strategy and operations of every business. And the reason for this is not just an ethical one, but is also, and very importantly, a financial one. So in this series of lectures, we will argue that companies must have standards for disclosing information about sustainability topics, which are material for their business. And these standards must be clear, globally comparable, and useful for investors. It's a very simple concept, but very difficult to implement. Now, the investors themselves are demanding the standards because transparent disclosure is becoming a prerequisite for obtaining capital. And this is a very important objective in the African market, everywhere in the world, but in particular in the African market. So today I will start by giving you some numbers on climate risk. Climate is just one aspect of sustainability, but maybe the most urgent one. I will give you some numbers on what kind of risk are facing Africa and in general African countries. And then Didi, starting from tomorrow, will focus more specifically on the African market. So we know we have a diverse audience today. So for people who are more interested on the technical side of standards, hang on. So you'll get more tomorrow from Didi and then on Monday from Richard. So Richard indeed will describe the standards which are set by the SSB in detail. And the last lecture will be a panel with African regulators to discuss progress and challenges in the adoption of the standards in the African market. Okay, so we will really be, we will give you like the input for people who are on the ground and who are making the difference. So let me start with my part. So I hope that the slides are visible. And so as I said, my lecture will be basically in 3 parts. First of all, I'll talk about climate risk, and then I will talk about why market and regulators need disclosure. And then I will give you a little bit of the history of, the regulatory standards, where we are in the world about setting these standards and how much progress have been done, lately. So let me start from a very simple issue on the macroeconomic risk, which is, the notion of the carbon budget and the terrible, fact that the carbon budget is actually shrinking. But what is the carbon budget? The carbon budget is the estimated amount of carbon dioxide the world can emit while still having a likely chance of limiting global temperature rise by 2 degrees centigrade above pre-industrial level. So it determines the input of CO2 to the atmosphere by emissions from human activities, balanced by output storage in the carbon reservoir on land in the ocean. So where are we now with our carbon budget? The current rate of CO2 emissions into the atmosphere from human activity is outpacing the rate of absorption out of the atmosphere. and into the oceans and land. So this results in a huge imbalance, and this is actually, the basic fact from which we have to start, because these risks are materials for humanity and then for the business sectors as well as a consequence. Here, these are data from NASA, and which kind of visualize, what kind, of risk the globe is subject to. And this is compare, these are the temperature anomaly compared to the 1951-1980 average. And where is red, it's really where the anomalies are higher. And, it goes from pale yellow to red. So you can see the map. And if you focus on Africa, you'll see that most of the risk are going to be in this area, in the northern part of Africa. Now, in terms of cost of extreme weather events, the costs have been rising quite steeply. You see in this curve, the trend is quite, is not very pretty, actually. We're trending upward. And, the bars in blue, they give you the number of events, and while the line give you the economic cost, okay? So this is the increasing frequency and the cost of the extreme weather events. Now, this has a macroeconomic impact that goes through demand for goods and services, because it affects investment, because there is uncertainty about climate events, which is a toll on investment. It affects consumptions, increased risk of flooding for residential property, affects negative consumptions. It affects trade, because it's a disruption of imports and export flows. And then, of course, it's also affecting the supply, labor supply, loss of hours work due to natural disaster, and energy, food, and other inputs, lead to input shortages, and then, damage to the capital stock due to extreme weathers, and, also, increase in technology. So, macroeconomists think in terms of demand and supply, so you can identify, the components of demand and the component of supply is related to these extreme risks. Now, one question is who are the countries which are the big emitters, and where are the risks? Now, historically, the big emitters have been the developed markets. This is not surprising, because, these are risks which are really, the product of industrialization, and so of human action. So countries that have been industrialized in the Industrial Revolution, those have been historically the big emitters. Increasingly, emerging markets are the big emitters, in particular China and India. But the risks are independently distributed for where the emissions are, okay? So the fact that you're a low emitter doesn't mean that you are free from this risk. And actually, significant risks are materializing in sub-Saharan Africa. So let me just give you, this is a picture from the data of the Global Carbon Project, which gives you the historical dynamics of the total CO2 emissions by world and region from 1750, that is the early Industrial Revolution time. You see that, in the early period, you have a lot of pale blue, that's the US, a lot of kind of yellow, which is the Europe, excluding the 27 and Europe 27. So, but then, if we go towards the end of the last centuries, you can see that China in particular is getting a big bulk of the total emissions, and now increasingly India, while Africa, which is the focus of our lectures, is still very small in terms of, in this distribution of emissions. Now, let's focus then on Africa, and I really want to make 2 points. The first one is that Africa is one of the lowest contributor to greenhouse gas emission. However, Key development sectors in Africa have already experienced widespread losses and damages, including biodiversity loss, water shortages, reduced food production, loss of lives, and reduced economic growth. And this you can see it actually on this chart here, where you see here the emission per capita on panel A. You see that Africa is a low emitter. We have 2 points here, 1990 and 2019. Africa is a low emitter with, in comparison with Europe and North America in particular. And on panel B, you have the trends, which tells you that Africa is on an upward trend, but not as much as Asia. But then, if you go to panel C, you can see that this is while the first in panel A you had emission per capita, then if you just look at emission not per capita in panel C, you see that several countries in Africa, they have started, emitting quite a bit at higher level of emissions in 2019, if you compare to 1990. And if you look at the emissions by type of gas, and the emission here, look now at panel D, is especially in agriculture and in energy system. And, it's different type of gases, but okay, let's focus. I think this is the last panel on D, it tells you really where the emissions are. So that was the first point, okay? Africa is one of the lowest contributor to greenhouse emissions, but, now it starts, being part of the story. The second point is that, the vulnerability of climate change in Africa, even if Africa is not one of the big emitters, are quite large. And here you can see it from this chart. So, and the important thing here is that once we go above the 2 degrees centigrade, then we will have a very high level of risk for very different areas, okay, on biodiversity loss and ecosystem disruption, mortality and morbidity from heat and infectious disease, so health is also a risk, and reduced food production from crop, fisheries, and livestock. So this is the second point. The risks are substantial, and they are actually multi-dimensional. So let me now get to another point, which is the dynamic of wealth in African countries is related to the dynamic of renewable capital. If we look at wealth in a countries, we can say some of this wealth is human, okay? So our human capital, our stock of people and the level of their education and capabilities. Then we have produced capital, machines, infrastructure. And then we have natural capital, which we can distinguish between renewables and fossil fuels, non-renewable. So here we have the produced capital and human in yellow, summed together. And then in green, the renewable natural capital for a bunch of different countries. And you can see that, we have, negative renewable natural capital. Here is the rate of growth from 1995 to 2018. So where you see negative in renewable capitals in some of the most fragile countries on the world. And some of these more fragile countries of the world are actually in Africa. You can see Burundi, very low accumulation of human and produced capital and negative renewable capital. You can see Liberia, but you can see Gabon and also Nigeria and, and Central African republics. Now, so this declining wealth, so is correlated with declining renewables. I want here to focus on 2 countries in particular, Gabon and Nigeria. So this is are the best examples of decline in multiple types of wealth. Although their non-renewable wealth, mainly from fossil fuels, increased by more than 30% during the 2004-2014 commodity boom, in particular due to the newly discovered deposits and the increase in fossil fuel prices, this non-renewable wealth dropped below the pre-boom levels after 2015. And this is true for both Gabon and Nigeria. So this is tell you that to rely on fossil fuel, you can do very well for some periods, but you're subject to a lot of volatility in your stock of wealth, okay? And so that's why you have to diversify. And, so these countries, are amongst the largest, the countries that have seen the largest decline in renewable natural capital per capita. Now, to give you some number, Gabon dropped from $1,400 to $1,200 in that period, and Nigeria dropped from $3,000 to $1,300 in fewer than 5 years. And of course, the decline of this asset affected the country's total capital per capita, especially after 2015. So there are other examples, however, and in 7 of the 11 sub-Saharan African countries with declining or stagnant wealth per capita, the deterioration of the renewable natural capital per capita is the main cause of the decline in total wealth per capita. And these countries, these 7 countries, are Benin, Burundi, the Democratic Republic of Congo, Gabon, Liberia, and Madagascar. And here in this kind of rather messy chart, you can see, well, in blue, you have the wealth per capita at the beginning of the period in 1995, and at the end, the wealth in 2018. And then you have the decomposition of types of capital in rate of growth for these different countries. And you can see that in all these countries, the loss of renewable natural capitals, you see in red, the red where you have the minus in that period, is basically a depletion of renewable natural capital. And the main cause of this decline include loss of forest asset and loss value of croplands. So, I mean, these are macro risks, but, from a business perspective, which is the perspective we want to take, in this course, these are obviously very tangible risks and clearly material and also financially material. So how should we understand this risk? Okay, this is quite a useful risk map, which is prepared by, the Treasury, is adapted by the DG Treasury, but I think it's quite useful for any countries. I mean, this was, prepared in the UK, but it's useful for any countries because it tells you, the channels and the spillovers of these different risks. So if we stick with climate, there are 2 types of sources of risk, what we call transition risk, which have to do with the fact that because of the macro risk that I described, policies are being implemented in order to favor the transition, okay? So that, and also preferences are changing. So, for example, we have carbon taxes, or we have limitation on emissions, or we have policies that will try to support certain technology that will favor the green transition. And also we have changes of investor preferences. Investors are changing where they want to put their money, especially long-term investors. So we call this the transition risk. I will give you some example later. And then we have physical risk, which they're the most obvious, okay? So these are linked to extreme weather events, and in long-term changes in climate pattern, which will affect certain part of the countries, and of course affect households and business. Now, this risk impact on the sovereign, so on the fiscal capacity of a country, It impacts on firms, on sectors through their sale, the operational cost, their capex, their valuation, asset equity valuation, and of course it impacts households if they are exposed. So the business risk have an effect on credit risk, market risk, liquidity risk, insurance, operation, and so on. And this risk feed back, on the sovereign and on the sectors and on the household. So you cannot really analyze, the business risk without understanding what's going on, in terms of macro risk, because these two things are really related, and there are these feedback loops which are really, really nasty. Okay, so let's then focus more on companies. So, this is sustainability factors, because I hope that I will convince you by my motivational slides, are becoming a mainstream part of investment decision-making. The investors want to know what's going on, how much firms and companies are exposed to this risk. And, this is from the investor point of view, the investor and the lenders also financial institutions, banks, and so on. And, and these factors are also important for the companies themselves, so that they have to take into consideration this risk when they plan, when they formulate their strategy, when they manage their companies, and also when they report, okay? So when they report about, when they do disclosure and when they report and prepare their disclosure document, their accounting document. So sustainability can affect companies' prospect and also to deliver financial value for investors. Now this value for investor is linked to what the companies do to stakeholders, who they work, with whom it works and serves, society in which it operates, and also natural society, resources upon which it draws. This is a kind of, it's something that, it's becoming more and more important for financial regulators, for investors, for policymakers to understand this fact that the value creation is intrinsically related to the impact that companies have on their environments and on the general stakeholders. And we will have more and more discussion of what that means when it comes to reporting in the next lectures. Now, I already mentioned that there are two types of risk, okay? The risk associated with the transition to low carbon and the mitigation policy. And also one important transition risk is stranded asset, okay? There will be, some asset that will be totally stranded because of the effect of policy. So that will affect valuation, and then the physical risk, which I describe. Let me just give you, some idea of the physical risk, okay? I mean, for example, if you are in an area where we have invested in real estate and this is subject to flood, okay, so there is repricing of real estate, or for agriculture, this is even more obvious. And these are the physical risk. The stranded asset, I put it under the hat of transition risk. As I said, transition to lower emissions will mean possibly that a larger fraction of reserves of fossil fuels become useless, we become stranded. And of course, you have to anticipate it if you are a company working on that sector, what will happen to your asset once the policy are put into place. And if you don't, I mean, you have to face the possibility that there will be fire sale if these assets lose values. And, this is a risk for a company, but it could be a risk for the financial system in general. So this is why also financial regulators are very much interested in these ideas, okay? So let's say that is the risk related to the stranded asset is not reflected in the value of the companies that extract, distributes, and rely on this fossil fuel, then this asset may suffer from unanticipated sudden write-downs, devaluations, or conversion to liabilities. Okay, so the financial risk, therefore, can be, are of these two types. As I said, risk associated with transition and physical risk. There is huge uncertainty about the weight of these two types of risk and their future evolution, so which will, creates a problem in reporting, which we will discuss in the course of this of the 3 lectures. And this could be thought of either as amplifier of existing risk or a separate category of risk, okay? We will discuss also that and what is the current thinking about how to classify the risk and report about this risk and so on. Now, from a financial system and the financial stability risk map, 3 things are important. The first is understanding climate risk and integrate climate-related risk into a financial stability monitoring and supervision. So there is a big action from the supervisors in this area. Second, disclosure on how this risk affect the value of the company. This will be our focus. And then standards, how to, have standards which are good enough, okay, for the investors and for, for evaluating, the values of companies. So on 2 and 3, which is our focus, to design an adequate reporting standards, adequate reporting standards is really key to deliver a sustainable financial system. Now, think about financial reporting. For those of you who come from the company side of, that you will know that financial reporting is very important for companies. It's a very important information for everybody, for investors and creditors and so on. We have a set of rules which we have matured in the last 20 years, which make the accounting statement comparable and more or less. I mean, it's not a perfect comparability, but investors know how to look at this document to know what they mean, okay? And so we need to achieve what we achieved for financial reporting standards. We have the same degree of comparability, transparency, global comparability for sustainability-related risk. I've been focusing on climate, but climate is not the only risk, okay? We also think of biodiversity, social, and so on. We will touch upon it a little bit later. Okay, so this is a big, objective, okay, and something that we need to achieve if we want to have, a more robust financial system, and if we want to understand, what is the value of companies. Now, so 3 things are important. Okay, so I said that. So now, these standards, they need to provide a degree of informational transparency that is needed for pricing and risk evaluation. They need to be global and comparable. I said that. They need to be subject to a due process and maintained, because they have to be to be checked and then maintained because the world changes, and they need to be adopted. So one thing is to produce the standards, but also they have to be adopted and that embedded in national legislation. Okay, so which is a very complicated process. And then they need to be subject to auditing and assurance. So we will, bring you to this journey, okay, from the standard setting to the adoption and so on. And we want to understand where Africa is in this journey, what needs to be done, what has been done already, and, evaluating the gap. And also, to try to understand what are the challenges and how to face these challenges, okay, in order to overcome them. Reichlin in particular will talk more about how we, the standard setting, what is the perspective of the standard setter. But let's see that, we think about this both in terms of risk, which I've described, but also in terms of opportunities, okay? So because the climate transition will also present opportunities for companies, okay? So on, new market, a new product, increasing resilience and so on. Now, both managing the risk and the opportunities will feed on the strategic planning of the companies and in risk management, and this will have a financial impact. So we'll have a financial impact on revenues and expenditure, and therefore on the income statement, but also on asset and liabilities, capital and financing, so balance sheet, and eventually the cash flow statement. So just keep this chart on the background, and we will return to that when we describe more in detail what the International Sustainability Standard Board is recommending to keep track of all this this map. Now, before we get into detail, I want to anticipate something that my colleagues will also talk about, but I think it's important to say at this stage that when you think about this risk and opportunity map, you really there are 4 thematic areas which are important, and this for disclosure. Okay, so one is governance. So we want the company to disclose, to have a good governance around this risk and opportunities. Also, strategy is important, risk management, and also metrics and targets. So you have to disclose the targets that you use to assess the relevant risk. Okay. Now, this idea, okay, so of these 4 components of disclosures builds on the task force for climate-related financial disclosure, which was an initiative of the Financial Stability Board, and which actually was very important to design this concept, which companies started adopting on a voluntary basis. Now, as I will describe, the TCFD is part of our organization, so that this idea has been kind of embedded in the new standards that the IFRS is proposing. Okay, so we'll return to that. So I think at this point, I will use my last 10 minutes to tell you where are we in providing a governance for disclosure. Okay, so I gave you the macro risk. I gave you the kind of brush through the company perspective, how the company should understand this risk, and these are the ideas that were the ideas of this organization that started basically started working, doing work on standard setting as a result of a demand for investors that wanted to understand what was going on in terms of, understanding the climate risk. And so this is the background, but now, recently, there have been official initiatives for standard setting. So the regulatory standard setting world has changed quite dramatically just in a few years. And so let me tell you a little bit about that, okay? So that, first of all, until recently, and still today, there are been a lot of initiative, okay? So there are initiatives by different countries. So different countries said, we need standards, okay? So, and the motivation is basically what I try to describe. We need standards, and so different countries have adopted different standards. Some voluntary, some actually mandatory. For example, the European Union has mandatory standards. But different countries have different level of ambitions in what kind of standards they want to, how intrusive the standards should be for companies to report. Some standards are just for the use of investor and the financial markets. Others have, standards that they're not just for investors, but are also standards which are important to achieve certain public policy objectives, for example, the Green Deal in Europe. So, but it's quite chaotic what we have out there, okay? So there is quite a lot of, different ideas, and which makes life for the preparers of the accounts quite difficult, and also for investors to understand, to compare and, to understand where they want to put the money on. And this is actually the landscape, voluntary initiative. I already described the TCFD, but, they're just voluntary initiative, multiple audiences, we want standards for investors, we want standards for public policies. And then we had different jurisdiction initiatives, okay, which are the jurisdiction initiatives tend to be mandatory in general, okay, not always, okay, but so it's kind of a little bit of these differences in standards are being called the alphabet soup, okay, because they have created a complicated landscape of different concepts and ideas. So given this background, in 2020, the IFRS, so the International Financial Reporting Standards Foundation, of which I am a trustee, decided to launch a consultation to ask the stakeholders, investors, company, regulators, and so on, should the IFRS, which oversee the standards for financial accounts for more than 140 countries, should also the IFRS get into this business of setting the standards for sustainability? Is there a need for that? And should the IFRS do it? And, the result of this consultation was, yes, you should do it. You should put some order into this mess. And you should have, ending the alphabet soup, it was called. And you should have a transparent and global, we should aim at having a transparent and globally comparable standard setting framework. And so really this was very much demand driven, but the fact that we had to get into the sustainability standard reporting job as a foundation, and it was very much supported by the G20, the G7, the IOSCO, the security regulators, and the Financial Stability Board. Okay, so this is what I want to emphasize here is that we were just doing, financial accounting standards, but actually, there was clearly a demand for us to step in and become also a sustainability standard center. So a few words about the IFRS. So the IFRS Foundation was created in 2001 to develop globally accepted accounting standards. So these are mandated now for over 140 jurisdictions. So de facto, the IFRS is the global accounting language. Not all countries adopt the IFRS, but there is a lot of convergence there. It's an organization which is a not-for-profit public interest organization, which has a three-tier governance model, which is quite well designed for an organization which aims at being a global standard setter. There is a monitoring board which provides the oversight, and this, this is the kind of oversight also on the public interest aspect of our work. In this monitoring board, we have the IOSCO, sometimes the Minister of Finance of different countries and jurisdictions. Okay, it's a global organization. Below the monitoring board, there are the trustees. There are 22 of us, and we oversee the governance and the strategy of the foundation. And below the trustee, there are the technical boards that set the standards, and Didi and Richard are part of the Sustainability Standard Board, which is called the SSB, which is the new addition, because before we just had one of these boards, the ISB, that was responsible for accounting standards. Now we have two, the SSB and the ISB. And, you know, there we provide extensive and inclusive due process to maintain these standards. So this is the three tiers organization I was referring to: the IFRS monitoring board, the trustees, and the two boards, okay? SSB, disclosure standard for sustainability, ISB, the accounting standards. And then we have a number of, you know, advisory bodies in these governments. Now, what do I want to say here? So there are a few things which are important in this governance. The public policy oversight, as I said, the independence provided by the trustee, but also the fact that now we have two boards. And this one, everybody knows, the ISB is responsible for accounting standard for financial accounts. But now, you know, having the sustainability standard boards, this is not something totally different. I mean, it's an independent board, but the fact that they are under the umbrella of the same organization, it means that, you know, the connection between the two, the work of the two boards can be provided, so that, because, you know, what is financially material, you know, if climate, you know, risk, for example, are financially material, that will, you know, will obviously, you know, have eventually an effect on the financial accounts, okay? So this is very important. The second thing I want to flag is that the SSB builds on other organizations that were already there when we started this work in 2020, and that now have been absorbed in the IFRS. So we really build in existing knowledge, the TCFD that I already mentioned, but also the SASB standards and integrating reporting standards. So all these organizations were providing standards with an investor focus on what is material for investor for decision of investments and lenders. And we have the same concept that, you know, we will elaborate more on that later, I mean, with Richard and Didi. But, you know, this we not only created a new board, but also we incorporated all these different organizations. So in 2021, this is COP26, the SSB was announced. You see, you recognize all these guys here. This is our chair. I mean, our chair is the third on the left, is Erkki Liikanen, and here these are all the big guys in the world. So that was, the SSB was established. We went to a process of this consolidating with these other organizations. And then the third step, we actually, after intensive work from Nidhi, Richard, and their colleagues, there are 14 SSB members, now the climate standards are now eventually published. Okay, the organization is global, so these are you know, different offices that we have around the world in order to really provide a kind of global perspective. Not all countries are the same, and we'll see that there are very specific challenges and opportunities in Africa. And these are our recent highlights, okay? So on the 26th of June of this year, we published the two standards that will be described to you in the course of lecture 2 and 3. Then the Financial Stability Board transferred the TCFD monitoring responsibility to the SSB from 2024. That will be the case. So we have fully absorbed the TCFD before we had absorbed the other organization. And then the IOSCO, the security regulator, endorsed the SSB standards on the 25th of July. Okay, so these were important stones. And with this, I will stop, but I will briefly give the floor to Nidhi, because, you know, she can give a very short 2 minutes introduction to what she will be talking about tomorrow. You know, giving you the African perspective. Nidhi, the floor is yours. I will stop my video. You're mute.
The most famous words we still don't learn. Thank you so much, Lucrezia, and it will be a great pleasure to pick up tomorrow and do a little bit more, enter into the segue between what does this mean for the African continent in particular, and what is actually happening? Who are the countries that are intending to adopt? How do we find the balance between, we have the least emissions on the continent, and yet we only attract 3% of climate finance to the African continent? That's a gap. How do we close that gap? And how do the ISSB standards in particular, which are geared towards unlocking capital, that is, providing decision-useful information to investors, how exactly do the ISSB standards help to make that shift? So I'm going to deep dive and unlock that a little bit more and speak to, there are about 6 jurisdictions that I met with, or we met with 2 days ago on a regulatory roundtable. They're discussing roadmaps to implementation. So I will provide the theory towards what will happen on the panel on Tuesday, where we will have a number of the regulators, the exchanges, and some of the early adopter companies on the African continent discuss, what are the potential challenges and why is it that they're embracing the ISSB standards. And perhaps the last thing I would want to speak about is concepts like interoperability, proportionality, and connectivity between the financial statements and the sustainability-related disclosures, and what makes this initiative different, and why does it have so much momentum, and what does it mean to build a truly global baseline of comparable information that provides decision-useful information to unlock capital flows, and where are the opportunities and leapfrog opportunities in this regard for the African continent. I think that's about 2 minutes, and I will keep responding to the questions in the chat privately while I hand back over to Lucrezia to take questions.
Yes, thank you, Lydie. We have 10 minutes for questions. So, my chat is open, but I don't know how it works, Tiago. So it's people can ask questions through the chat, or.
Lucrezia, there are a number of questions in the Q&A. I've started responding to them privately. Maybe you can just pick the ones you want to take live, and I will keep responding and typing.
Okay, on the Q&A, sorry. Okay. So the first question is, you mentioned that emerging industry are growing in emissions. Do you see a growing risk in sub-Saharan Africa with a strong reliance to coal as an energy source? Definitely. I mean, I think that, that chart in which it shows the volatility related to fossil fuel, and that, it just gives you an idea of what it means for income and wealth as well, so in sub-Saharan Africa and the countries that are particularly relying on fossil fuel. But as Nili said, there are also huge opportunities, okay, and that in terms of solar energy, and but these opportunities have to be supported, of course, by financial resources and also by an informational structure, data, and so on, so that investors know, what's going on, where to put the money. Okay, so I don't know, Nili, if you want to say something more, but let me just maybe combine some more. Energy transition is slow in Africa. What can be done to bridge this gap, as climate change is transnational and global? Okay, so let me just, we'll get to that later, but there is one more specific one. What is the difference between wealth per capita and income per capita? Or this term can be used interchangeably in this lecture? No, there is a difference. Wealth is a stock, okay? So while income is a flow, okay? So income is, if you want, is the rate of change of the stock. So, the stock, what is the stock of capital? So typically the infrastructure of a country does produce capital, or, buildings, machineries, that's capital. Human capital, also that's part of the capital stock. Now, and then natural resources, okay? Now, this capital produces services, so a flow of services. So it could be income, okay? So that, the rate of change of capital is, for example, investment. So this is the difference. So these are two things, and the depletion of natural resources affect both the capital, the total wealth, and those were the numbers I showed you. But of course, it could also affect the income because, if by affecting, if the depletion of capital affects consumption and investment, those are flows, okay? Energy transition is low in Africa. What can be done to bridge this gap as climate change is transnational and global? So I will give you my 2 pennies, and then I will ask Nidhi to answer to that questions as well. It is absolutely right that a lot of policies which have to do with investment in technology and subsidies or carbon tax and so on, they have to have a big global component, and so they will have to be supported by some global governance. But there is also a lot that private investors and private capital can do. And this is why the standards are important, because capital will not go and will not invest in transition in Africa unless they have the information about what companies are doing. And this is why disclosure is especially important to mobilize private capital. But disclosure is not the only policy, okay? There are lots of other policy which pertain to the public sector. Nidhi, do you want to say something about that?
I think generally I was responding. I think policy is really important. So it's a combination of having the right policy framework. That's really important, and it's something that African leaders and government agencies need to take seriously. But what we're working on now is actually how to make sure that the private sector and where capital flows are is being addressed. And that is really critical because you need to be able to provide the right data. My thought is twofold, and then I'll stop. And I just wanted to say as well, I'll take as many questions as we have in the Q&A, and I'll try to weave them into the lecture tomorrow. So everybody who doesn't get their question responded to, at least I'll take a cue and adapt the presentation tomorrow to address some of those questions. So keep them coming. But two very quick things. One is many companies, in order to make that transition, and in order to invest in the energy transition, which is absolutely key because you need power to fuel industries, you need capital. Capital is more expensive when there is higher risk. And one part of that risk is the sovereign risk rating, which corporates can't really do very much about, but policymakers need to be aware of. The second part of that is the risk rating of corporates. And what we need to be aware of is that where there's no data, you will get the worst possible risk rating. And if you get the worst possible risk rating, you'll get no capital or very expensive capital. So what we're doing is addressing what we can address with these standards, namely, how do we provide decision useful information to ensure that African companies are right, that the perception of risk is not higher than the actual risk.
Okay, so I'm going to take okay, so there is some technical question. What is renewable capital per capita? So renewable, for example, forestry, water, this is renewable capital, as opposed to fossil fuel. Per capita is just that we divide by population. And as you can see from the chart I show you, for Africa, there is a difference between whether you divide per capita or not, because of course, Africa is an area of the world where there is a very high population growth. Now, then there is Rashid from Nigeria. The physical transition risk, can this risk be averted? How can they be prevented or probably managed? That's what we are working for. Okay, so the physical risk. I mean, where the world is going with the carbon budget, you know, we are going to be faced by more and more physical risk. And this is the message on the first chart I show you. Oh, and the transition risk will come from the policy that are being implemented in order to cope with those physical risks, which will mean that certain sectors will be uninvestable, okay, so at some point. So the two things are related. This risk cannot be totally averted, unfortunately, but you know, they will have to be managed, okay? And you know, there are different tools that policymakers can use, but on the side of disclosure, as Neely said, okay, at least you know, this is very important to mobilize private capital, and you know, which is part of the answer, okay? Because the public sector cannot just deal with the immensity of this problem. Now, Obed asked, IFRS sustainability disclosure standards are built or based on TCFD. They are built and based, I mean, they're based on TCFD. So the four areas that I described, governance, strategy, risk management, and metrics, and target, that this is the criterion that we have adopted. Of course, you know, our standards are more granular, and you know, and they go through a very complex due process, and Richard will spend quite a bit of time to explain, you know, what are they like, and you know, and what really that will imply for preparers in different companies. You will see that you know, for the smaller company, that will be probably a challenge, and therefore there is an aspect of our work which is also about capacity building, which is going to be very important in African countries. Now, looking at the limitations of data collection, with analysis and auditor's liability with respect to using work of an expert, can the auditor ensure that the data provided is reliable and accurate? That's an area of very active work, and the ISSB is working with CDP in order to have you know, a platform for data, but you know, we're still early stage. I think you know, the data collection will be challenging, but remember that the more the standards will be, the more widely the standards will be applied around the world, the more data we will have, okay? Because we will have all the disclosure data from different countries. But I think a lot will happen in the data provision industries, you know, because of these initiatives. I think we are out of time, but I see a lot of companies, a lot of questions, but Neely, you are taking, you know, getting track of them, and then you will address them tomorrow, okay? And I will be there tomorrow as well, in case there are questions more related to me, okay? So we will both be there all the time, okay? And I think we should, I think, is the time over, Tiago, or am I wrong? I mean, I don't mind staying, but I think we have a slot. What's the answer? Oops.
I think we should probably respect people's time.
Yeah, we should respect people's time. Okay, so it has been great to interact with you, and see you tomorrow.
See you tomorrow, same time.
Same time.
Look forward to that.
Okay, bye-bye.
Bye.